Okay, I believe we're live. Welcome,
Live.
everyone.
Hello,
Everyone should
everyone.
be filtering in here. We'll give everyone just another minute before we get started. Austin, how was your trick-or-treating last night?
Trick or treating was good. I went around with my godson. He was Spider-Man. Uh, you know, he definitely got his fistfuls worth. How about you?
It was good. My oldest daughter was also Spider-Man, but that didn't last very long. And then she was Elsa. And Hazel, my youngest, we dressed her up as Elmo. So it was
Okay.
good. I have an old hot dog costume that I use almost every year. It's awesome. I love it.
It's
So
always the old trusty.
yeah, we
Old
went to a
trusty.
neighbor's house with a couple of kids in the neighborhood, and uh, they had some little mini hot dogs. That they had some pigs in a blanket there,
Nice.
and so I was a hot dog eating a hot dog. It was quite fun.
So are you a ketchup and mustard kind of guy?
And relish, I
And
would say.
relish?
Yeah, heavier
Whatever
on the mustard.
toppings, yeah, whatever toppings you give me, I'm putting on it.
Yeah, there's some unique ones. Wasn't there a restaurant in New York City that started doing hot dogs and all these different variations from around the country?
Yeah. Denmark is like they just put everything on it. There's like five different or six different things you throw in there.
I heard Costco is actually thinking about raising the price of their $1.50 hot dog.
Oh wow.
Yeah, it
That
was
would cause
losing them
riots.
money. It
Right.
would, and I believe the CEO came out and said he would do some bad things if that ever happened a couple of years ago. And look where they are. But
How things
maybe he
change.
wasn't anticipating 9% inflation last year.
Right. He was in the transitory party.
How's that for a segue? Let's get started, shall we?
All right, sure. So it's 12:01. Let's do it. So my name is Austin Hagaman. I am here with my colleague Adam Armstrong. We are both advisors at Withum Wealth Management. We do have some listeners that are not clients. So just let me quickly jump through who we are. Withum Wealth is a white glove wealth management firm. We are not a broker. We are completely independent. And in addition to having a direct line with the CPAs over at Withum, we also are not handcuffed to any one financial institution. So we can work with multiple private banks, can hold client money at multiple institutions, and have an unbiased and expansive investment universe where we're not getting paid on anything we're putting you in. And that's important because about 85% of the industry does not operate that way. We want to be the 15% where the client can really feel that, we always have their best interest in mind. So today we're going to go through some topics ripped from the headlines. Some of the major media headlines we've been seeing. Talk about what we think we should care about, maybe what we shouldn't care about. We're also going to go through some charts about how to think about stocks, bonds, and cash in today's environment. This, if you're a listener that's coming back and listening to us again, you know that this is our quarterly market update booklet we're going to be moving through, and we're going to highlight some slides. If you'd like to dive in deeper into any of these topics, please feel free to reach out to an advisor over at Withum Wealth. We'd be happy to take you through that.
Absolutely. I'll just chime in. We had a great number of questions come in already. We're going to try and answer some of those throughout the presentation today, where they will fit in nicely. If we can get to the rest at the end, we will certainly do that. If not, we will absolutely have someone reach out with an answer, or we can talk to you about what your question is. And there's also a Q&A box that you can ask. Feel free to ask live as we're covering things. We can try and get to some of those. Down at the bottom of the screen, you should see that Q&A box.
Right. All right, so let's jump into things. So I almost don't even want to talk about this because I feel like as advisors, we're always talking about this these days, but inflation. Can you give us
Yeah.
an update on where we are, Adam?
Oh, we've made some really good progress. Upwards of 9+% headline inflation last year. Through the summer, we've been banging the drum, focusing on this slide almost every single economic webinar we've done since, talking about how structurally, with the month over month data coming in, we should be down under 4%. We said by the summer. I think we actually said by the fall in the winter presentation, we had to water down our true expectations, but we hit that. We were lower, I think down around 3.1% in what was it, July? I believe the July reading, and we've come up a bit since then. But a lot of that is structural in the way the data is shaking out, and we wanted to dive into that today. So just out of curiosity, Austin, if I told you 2% inflation, do you know month over month what that would require prices to increase each month to hit that 2% goal?
2%. That would well, let's see, you just divide by 12, right? So that'd be somewhere between 0.1 and 0.2, right?
Yeah, exactly. Yeah. It's about 16 or 17 hundredths, so 0.167%. You can draw a little line there across the screen. So that would just be on average. Let's say 0.2 to make numbers easy for people to understand. What you can see is that October, January, February, April, August, and this past September, all of the monthly inflation data points are above that 0.2% level that we want to see. Okay. Nothing's been below 0, which is interesting. Typically, you have some months of price declines, but getting from 9% to where we are today at 3.7% inflation very well could have been the easy part. The hardest part is going to be going from where we are today in the mid 3s, maybe upwards of 4% by the end of the year, down to the 2% goal that the Federal Reserve has. That's going to be tough because all of these individual months of 0.4%, 0.5%, 0.6% this past August, they're going to be part of that 12-month rolling data. And, we're going to need to see some negative months to really get down to that 2% inflation goal within the next year.
Right. So, just to be clear here, each month here, this is the month over month inflation for each month.
Yeah.
So, right now the 12 months is right there. We really need these higher months to drop off, right? So, one, we need them to drop off, right? Once you get this 0.6, it's going to be very hard to get to 2 with a 0.6 on the 12 month.
I mean, we had 1 full percent price increases between August and September. That's not good because that's going to be sticking around for the next 10 months as part of the data set.
Right.
So how do we get to 2%? Really, that's why the Fed has kept interest rates higher for longer, or they've raised rates as high as they have. But ultimately, we think they're going to stay true to their word, keep rates where they are until either something breaks in the economy or inflation really does cool off and we can orchestrate this soft landing that they are continuing to talk about.
Right. And that higher for longer verbiage, to me, that seems kind of scary, right? What does that even mean, right? Higher for longer. Could that mean that we're going to keep rates where they are for 5 years? I doubt it. I don't think so. We think, and I think the Fed also thinks it's probably going to be, over the next 12 months, we're going to start to see rates coming down. If you look at the Fed dot plot, right? So higher for longer doesn't necessarily mean what I think most people would interpret of, a multi-year period, right? It's more of a multi-month period of just leaving rates where they are to let the markets, the economy digest the current rate environment where they push it up to before bringing it down.
Right. Well, how high is high and for how long is longer, right? I think those are 2 very big questions. And a lot of that's going to depend on the data over the next, call it 6 months. I don't see them changing anything. But, come the summer next year, if we are around 2.5% inflation, let's just say, yeah, there could be a couple rate cuts because 4.5% Fed funds rate could still be restrictive and tight relative to where inflation in the economy may be at that point.
Right. So you mentioned things breaking. And I think that has everyone kind of on this heightened view of, well, what's the next thing? What is going to break? Trying to spot that next thing, or what's that next data point or event that's going to cause a break in the economy. One of which we've been hearing more and more about is student loans. So let me hop to our student loan and also just, I guess, delinquencies in general. Would you mind taking a minute to talk about these three charts here?
Yeah, so this is, can we actually dive back? I want to set the stage for this slide. Let's jump back to the consumer in general. This is something we've been, specifically the top right chart here, but checking on the consumer and how their balance sheets are doing. What are they saving? What is their rate of saving post-pandemic? We know that people came into just an exceptional amount of stimulus, businesses as well. And how has that been shaking out in an era of higher inflation, pent up demand, et cetera? And this chart on the right is really our way of looking at the health of the consumer. Okay, so you can see this darker blue line that spikes up there in 2020 and spikes up again in the winter of 2021. That is the personal amount of money being saved by consumers. And what you can see is up until the pandemic, it was wildly stable. Okay. That spiked for obvious reasons in 2020. We were all locked down. We had nothing to spend our money on. In 2021, there was another also stimulus checks. In 2021, there was another round of stimulus checks. And then we also had the Omicron variant, which caused people to reduce their travel, et cetera. So those two events caused this massive excess in consumer money, excess savings. And that's the shaded blue line here. It amounted to about $2 trillion in excess savings. And what you can see is that's when in 2022, all this pent up travel demand plus inflation raising the cost of goods started to eat away at that savings. So people were spending more than they otherwise would have, albeit either because goods cost much, much more, or because there was this pent up demand and people took, 2 vacations instead of their normal 1 vacation that they missed out on, right? And you can see since about the summer of 2021, when COVID really, people's attitudes started to return to normal, we would like to say, that's been declining pretty steadily here. And you can see we're going to hit basically where we would have been in terms of excess savings right about now, before the end of the year. We talked about this, over the last couple of webinars too. So I want to set the stage here and talk about this because people are running out of their excess savings. This is something we're measuring. So what's going to happen? Are people just going to stop spending on, luxury goods and discretionary spending? That's probably not going to be good for the economy. Or are people going to start saving more finally? Or are they going to continue living at the quality of life they're used to, but take on more debt to do that in hopes of taking on a second job or whatever it might be? Okay, right. So I think this is an important slide to explain, to set the table for delinquencies and student loan debt coming back online. And what we can see now, if we flip forward, Austin, to the delinquency slide up here on the top left, we have noticed that over the last couple of years, since the Fed's rate hikes became more of a reality, you can see here in late 21, early 22, delinquencies started ticking up there on auto and credit card loans. These are late payments more than 30 days. This is a leading economic indicator, something that precedes debt defaults due to people not being able to pay on certain types of loans. And what you can see here is in the 2006, 2007 timeframe, before 2008, both of these types of loans started to turn up. Delinquencies started to turn up. Now, the good news here, I do want to say that we are really just at the level of delinquencies we were through much of the last decade. Okay.
Right. I was going to say that if you look at where we've been, it doesn't really look that bad. It's just more of the direction, right?
It's the direction that's concerning. This is, what we're trying to do here is observe trends in the data and make sense of whether it's noise or whether it means something, right? Now, the important thing here is that student loan line has been basically nil since the Biden administration suspended student loan interest payments, right? The bad news is that those interest payments are now coming back online. And so the bottom left chart here shows sort of the pre-pandemic trend of how much money was being spent. You can see it was 60, $70 billion in 2020 on student loan debt. Okay, that's a lot of money. This is on an annualized basis, but that's a lot of money that wasn't going to student loan payments over the last several years, that was going towards other types of spending. And that is set to come online. You can see this dark blue line here over the summer really starting to spike upwards, okay? And so this was a study done by Goldman Sachs, and they said that because of, favorable repayments, an income-based repayment plan that the Biden administration has now since enacted, not saying not everyone has to repay, but it's only based on your income, you may have to start repaying your loans. 70% of borrowers restarting their payments and 15% restarting over the next 12 months. That green dash line gets you back, by the end of 2024 to what people were spending. So hopefully people have been planning on this and not just blowing through their cash savings on vacations, knowing that they're eventually going to have this debt come due. The other so I guess the first takeaway here from this bottom left chart is it's probably not as bad as the media is making out to be. This is not something that's going to upset the global economy, this level of spending, $100 billion. While it's a lot on an annual basis, we're talking about a 20+ trillion dollar economy here just in the United States.
Right. And look at the amount of loans that are, the level of debt people have on their books in terms of the student loan debt.
Exactly. That's sort of the second arrow in our quiver from a bullish point of view. And, this point is really just debunking a myth that's out there in the media right now. But this is showing on the left axis here, you have the amount of the loans outstanding. So under $10,000 at the top, $10,000 to $20,000 in debt, and so on down to the bottom line is how many of these outstanding loans are over $100,000 in debt. That is the green line. So a higher percentage of loans outstanding are actually in the lowest dollar value, and the percent of that debt is pretty much an opposite relationship. Okay, so you can see that yes, obviously the bigger loans make up more percent of the total debt down there at the bottom, that big blue line, but you can see that it's a very small percent of the actual borrowers that are going to have these higher interest payments restarting. So it's a small subsection of the economy, of the spending is going to be affected ultimately, is what we're looking at here.
Right. So from what I'm hearing, right, this looks manageable, one. Two, to the extent that it's not manageable for certain people, it's going to represent such a small part of our economy that this probably is not going to have a huge impact on the stock market or the bond market.
This isn't like variable mortgage rates affecting 50% of the population that own a home. Yeah,
right.
It's a small population that owns student debt, but the numbers seem very big in the sensational media that we're used to today. But when you look under the hood here, it may not be. And look, I'm sure we're going to see delinquencies rise, just like we are with auto and credit card loans. But again, is this going to be at a level of concern or something causing a recession? Probably not.
Right. And who owns that debt, right? It's really the U.S. government. So it's not like we have private companies back in 2008 that were holding mortgage-backed securities that were going belly up. We have the government holding it. So if we do start to see delinquencies, it's the government who pays the price. I guess that falls through the taxpayers, but it's not like we have to worry about major companies going under that would cause a shock within the entire market itself.
Yeah. Before we jump forward, did we want to tackle? I know we might want to jump back to this housing question that came in. And there was just a quick question on
Mhm.
mortgage delinquencies. That's something we have not seen ticking up quite yet, foreclosures or anything like that. One of the biggest reasons for that is due to just the overwhelming amount of mortgages that were refinanced at very low rates. I think it's somewhere around 70% of mortgages, 65 to 70% of mortgages have a fixed 30-year rate of under 3%, under 4%, excuse me. So again, small percentage of people with higher rate mortgages, even less with variable rate mortgages that will be coming due.
Right. And that's important because the raising of interest rates isn't really impacting those who are already locked in a mortgage, right? And by the time that their mortgage is, matured or fully paid up, we're going to be in a completely different interest rate environment.
Yep. Yeah. And I think maybe that's one of the reasons why these rate hikes have been very drastic, but are not affecting consumers as quickly as maybe the Fed would have liked.
Right. Right. Did you want to talk at all about the stickiness of housing?
Yeah, we can dive into that. So this is related to a question we had come in on Bloomberg this morning. There was a professor that commented inflation after you take out housing was actually at 2%. He was commenting that this was a better way to look at inflation because housing is a lagging measurement. I agree. If you want to split the data in 100 different ways, we could draw probably 50 different conclusions. That being said, housing is a majority of what our cost of living is as individuals. So we've done a number of studies actually that look at the relative cost of renting versus owning a home. And owning a home is still relatively pretty expensive related to the cost of rent. And part of that is due to the rise in prices. Part of that is due to the increase in interest rates as well. So if we are going to see housing prices remain elevated for a number of reasons, and we had a few questions come in on housing and real estate. So hopefully we can chat for a minute here and talk about this. There's a very low level of supply, which is keeping prices elevated despite interest rates being high and mortgage rates being high. So rent should continue to increase, or at least have a floor to the point where the renting homes won't decrease because housing prices haven't decreased, right? So the relative cost of renting can still appreciate a good amount to keep up with all of the housing price growth that we saw over the last, call it 3, 4, 5 years since the pandemic. Even if rates do fall, I think that yes, more supply may come online, but there's probably so many people waiting to buy houses, waiting in the wings, that will be able to afford more price, greater prices for homes than today if rates are lower. So you kind of have this, at the end of the day, what this comes down to is we need more housing supply. Okay, we just need more new homes on the market. All through the mid 2000s, there was just not enough new supply of homes being built. You also, I think we're going to have to wait probably 5 to 10 years for baby boomers to start, the baby boomer generation either to start passing away, moving out into retirement communities, going to assisted living, for those types of homes to come online. That's going to be a much longer and slower demographic shift over the next probably 10 years that will affect longer term housing prices. But as far as the short term outlook for real estate prices, for interest rates, and how that relates to rent and housing inflation, it's a pretty murky picture. And that's an area where we don't see, because housing prices haven't really come down in value much, we don't see rent really slowing as a portion of housing inflation, or general inflation, I should say.
Right. And I don't really think that a 30% decline, let's say, in housing would have a large market impact on the overall market. The dynamics within housing are different than they were in 07, 08. We don't see people over leveraging like they were, right? So, that may actually be a catalyst for growth, seeing housing come down a little bit. That I don't know that would necessarily create a big market shock if we did see it. In fact, I think that we would, that would be something to look forward to.
No, I think the only way that housing prices are really going to meaningfully decline would be in a recessionary environment. So if we got a recession where unemployment starts rising north of 4.5%, 5.5%, then you start to see foreclosures, right? We had a question on mortgage delinquencies. Then you would start to see foreclosures and people underwater on their homes, and that's when fire sales start to occur, right? So
right.
That would be an instance where housing prices could decline.
Right. All right. Should we jump to government debt?
Yeah, that was a. Hopefully, folks found that helpful. We don't really. Maybe we'll get some real estate specific slides in here for the next for this winter. Yeah. Nice. So government debt's another huge topic that's been on folks' mind. We had a government shutdown that's now the can's been kicked out to November, I believe, in a couple weeks, over the spending budget debate. Look, what we want to get across here is that government debt, it is growing in terms of a problem. The cost of our interest rate and the cost of servicing our debt is increasing. However, it's probably an issue over the next couple of years, and probably not an issue for the stock market as it relates to the next 3, 6, 12 months. Okay. So what are these charts? The top chart here is just showing that over time, over the last 20 years, I want to focus on the green line here. The amount of debt maturing within 1 year or less has been increasing. This is an example to really show that most of our debt is short-term debt. We issue debt to pay for our spending today, and then the next year when that debt comes due, we issue more debt the next year, right, et cetera. So you can see 31% of all of our US government debt, which is pushing what, $20 trillion, $22 trillion at this point. So 31% or $7.6 trillion of our debt is going to mature over the next year. Now, Austin, do you remember what interest rates were last year this time? 3%, 4%?
Last year? Definitely lower than they are today. I would say probably 3.5, 3.5.
Yeah.
4. Yeah.
That sounds about right. So now if I need to issue more debt today, what's a 1-year treasury paying me today? 5.4%?
Yep.
Right?
Well over 5.
So you can see the government's interest expenses are rapidly increasing, right? That's not a good thing, but there's a silver lining here, as with most of the stories we like to tell. Okay, this is not going to be necessarily an issue today, but that's because on the bottom right, the interest costs as a percentage of our GDP are still below some of the historical averages. I'm actually over on the right for this topic here. So the interest costs on all of our debt as a percent of GDP is really sort of in this 2% range. That is outside of much of the 80s, the last time we saw a massive inflation spike, and the last time we saw interest rates really rise meaningfully and dramatically. We're still not at those levels. It is expected to rise to those levels and possibly above it over the next 5 or so years, unless something is done. And here's the key: unless something is done, right? So what could be done? The government, as you can see on the left chart now, we're going to jump over there, their interest as a percent of their revenue is actually going to start exploding. Okay. Now, think about this for a minute. The government's not a business. We have a lot of business owner clients, but what would be the government's revenue in this case? Obviously, if you are a business owner, you have a service or a product that you sell for money. What does the government do to get revenue? They take in tax receipts, right? Yeah. So this is a problem here, more so for us in terms of the implications that are going to need to happen down the road. Okay, so the government, if they have higher costs, that means to offset those higher costs, they're going to need to start increasing their revenue. And how does that happen? or I'll get to another thing later, but that would happen by increasing the taxes that we would be paying. Okay, so in 2026, the tax I'm going to mess this up. TCJA, the Tax Cuts and Jobs Act that Trump enacted in 2018, is set to expire and sunset. That would send income tax rates higher, corporate tax rates higher, and there's been some talk that it will get continued, but this is something that would be a little bit more concerning for consumer spending, again, out in 2026. Not something the market's concerned with today, but a later problem. Okay, so the government could increase their revenue in the form of increased taxes to help offset some of these higher interest costs if rates stay elevated for a while. The other thing they could do is lower their costs, right? So they could stop spending as much money. Maybe they don't employ as much people. That's kind of also a bad thing for the economy too, right? And again, this is not necessarily an issue for today, but it's a very hot topic in the media. People are always talking about the size of our debt being unsustainable. It's really starting to get closer and closer to that point of we need to do something, we need to take action to revert some of these trends.
Right. And while no one likes to pay taxes, I was trying to look up the exact numbers while you were talking. While no one likes to pay taxes, the US actually has a pretty favorable tax rate compared to some other countries, right? So, theoretically, there is room for it to move. What I'm hearing is we're not so worried about investment implications from this conversation. We more or less think that the politicians have enough levers to pull, some of those levers being things that, we necessarily wouldn't like to see, but, like raising taxes or cutting back on certain government spending, et cetera. But this to us is more of a long-term problem, not a short-term problem, something that needs to be addressed. It obviously needs to be addressed based on the numbers that we're looking at. We've heard this conversation before with when looking at projections. The projections always look like it's a roller coaster ride, working its way to the top. But we've historically found a way to keep everything in check. We just may not like it the way that they're keeping it check from a tax standpoint.
Yeah, it's interesting. This is much more of a political issue, I think, that needs to be worked out than anything sort of economic to be worried about. But look, in post World War II, I think it was post World War II, but I believe it was Eisenhower. The top tax bracket was 91%. So 91 cents of every dollar you earned. I believe back then it was over $1 million, which today's day and age might be like 50 million bucks, but with inflation. But the point being, most of your money you weren't even seeing it was going to taxes. So is there, and a lot of the very, very, wealthy billionaires out there are saying, please tax us more, so I don't know. This seems like more of a political debate than anything economic to be worried about, I guess, is the takeaway here.
Right. But I would expect that we're going to continue to hear about it. It's just a hot topic. We really can't turn the TV on without hearing about it. There are some people arguing that maybe the government should work more like a hedge fund, right? Lock in lower rates, do things purposely to try to outperform, so to speak. I'll leave that up to, our politicians, but I would not expect this conversation to go away anytime soon, especially as things heat up politically. But I think the walk away here is we don't think that there's a major concern from an investment standpoint.
Maybe Jerome Powell should hire Withum Wealth Management for some advice.
There you go. There you go. If you're listening, Jerome, our phones are open. So we've been hearing more and more questions about, where do I put my money today? Or, when's the right time to invest? Cash looks very attractive. What does that mean? So let's run through a couple slides here about those topics. Let's move this to blocking. Okay. So the yield curve has moved quite a bit. We have had people in the past say, you keep talking about the yield curve and you keep showing me the yield curve and I don't understand the yield curve. So let me just quickly explain. So at the bottom, on the bottom axis here, we have a 3-month treasury, a 1-year treasury, 2-year, 3-year, 5-year, 7-year, 10-year, so on and so forth till a 30-year US treasury. So a 30-year US treasury, a bond that's going to mature in 30 years. The gray line at the bottom here we have different yields. So for each treasury, that matches with the left axis that shows a yield, how much you can earn from holding that treasury. So for example, the 5-year US Treasury back in December 31st, 2021 was yielding 1.3%. The 20-year was earning 1.9%. Fast forward to today, the Fed jacked up interest rates, right, to September 30th. Now, rates have actually moved up a little bit more since that point. But if we look at the 5-year, that's earning 4.6%. And the 10-year is earning almost the 20-year is earning almost 5%. So you could lock in almost a 5% yield over a 20-year period.
Yep.
Now, what our clients and prospects are really focused on is this part of the yield curve. Would you mind taking a minute and explaining what's going on here?
Yeah, this is, the Fed in their policy, what they did was they raised interest rates to combat inflation. They want to cool off demand for goods and services so that goods and services stop inflating and seeing prices increase so dramatically. So this is what the Fed deals with and changes, is the shorter end of the curve here, the shorter duration bonds. The longer end fluctuates with anything under the sun, from longer term inflation expectations, growth in the economy, the risk associated with the debt instrument that we are tying our money to. Okay. But I want to focus on, the fact that the bottom curve from December 21 is what we call a positive sloping yield curve. You should be paid more, okay, for taking on more duration risk. That's a normal instance in market environment, right? If you have no risk over the next 2 months, we're only going to pay you 0.2%. If you want to take on risk for 30 years, we're going to pay you almost 2%. That's normal. What's not normal is being paid more for shorter term debt. And this can cause stress in the marketplace, but it can actually cause really interesting opportunities for investors. So if your goals and your time horizon for any amount of money that you have is under a year, now is a fantastic time to be buying a 1-year treasury, buying a 6-month treasury bill, maximizing your yield over that time period.
Right. If you have excess cash sitting in a bank account right now, earning almost nothing, you're losing, and you're actually behind the times too, right? You really want to look at maximizing that. We're getting it, right? You can get the full faith and credit of the U.S. government backing your money for 5.5% yield. If you're a New Jersey resident, these are New Jersey state tax free. So you're looking at over a 6% yield on a tax adjusted basis. So that means you would need to earn above 6% on, a savings account or a CD in order to earn the same amount net tax as you would from a U.S. government bond, right? So it really makes sense to do that. If you haven't already, you got to lock that in, unless of course you need the money tomorrow.
Yeah, and look, to be frank, the Treasury Direct website where you can go and do it yourself is just a clunky beast, and you don't want to deal with that. So talk to your advisor. If it's not us, or if you want it to be us, then let's have a conversation about how we can do it for you. Because people are leaving money on the table, plain and simple, especially when you compare it to high yield savings, only still yielding, like Marcus and Ally are still yielding 4.25. So, even after a management fee, it's a no-brainer. But that's neither here nor there. What does this mean for our investment strategy or clients? Should they be locking in? I've heard so much on the media on CNBC about people saying, look, yeah, I'm going to lock in 5% for the next 10 years. I want to get into whether that's a good decision or not. If you have the time horizon, let's say you're not working for another 5, 10 years, 20 years maybe, or you're, even if you are retired and 60, I want to dive into whether or 65 or 70, you might still have 20, 25 years to live, and your time horizon is fairly long. I want to dive into whether this is a good investment opportunity or not.
Right. So while we have the visual up, I just want to point something out. So the Fed, like we said, inflated interest rates, right? They brought that yield curve up. Now, what we expect, what the Fed expects, is they're going to bring the yield curve back down when it makes sense. So, for argument's sake, let's say they bring it down to around, here where the 5-year is earning, 3%, and the 3-year is earning, call it 2.5. If you go out and you lock in today a 4.6% rate, right? So you have this rate up here and it starts to move its way towards maturity, right? When it becomes a 2-year, if your 4.6% bond is yielding more than you could get from a 2-year US Treasury, right? You're making out. And that's really what we're going to jump into in a second.
Yeah, exactly. That's why there's opportunities here to start extending duration. And we can go to the table now and jump over there. You want to walk through this table, Austin? I know you.
Sure, I can walk through it quickly. I know we've shown it in other webinars, and then also our podcast on Amplified Wealth. But let me just walk through this here. So the leftmost column, that is the month after the last time the Fed raised rates in a hiking cycle. Okay, so we would expect we're right about there. So April of 80, 81, 84, 85, 87, March of 89, etc. Then we looked at, if we move over, in that month after, what was the 2-year US Treasury yielding? What was the 10-year US Treasury yielding? Okay, we highlighted rose blue when the 2-year was actually earning more than the 10-year. Okay, now, why do we do that? So we have investors looking at us and saying, who have a 5-10 year plus time horizon, and they're saying, well, why would I take that? Why would I take risk? Why would I go out farther in the yield curve when I could lock in a 5.5% 1-year US Treasury rate? There's going to be virtually no risk, et cetera, et cetera, et cetera. And whenever something seems too easy, generally speaking, investors are missing something. So we said, well, let's see if we are missing something. So we said, all right, we know the periods when short-term rates were yielding more than longer-term rates. If we then fast forward 12 months from these dates, what was the performance dispersion between short-term US Treasuries and long-term US Treasuries? And what we found is most of the time, long-term US Treasuries outperform short-term, even in instances where the short-term was yielding more to begin that period. Okay. Yep. And that's because, this 10-year Treasury, you get to lock in that 9.36% rate. The Fed drops rates across the board. So in a year, that 9-year US Treasury isn't earning 9.36%. And that bond that you're holding on to is worth more.
Yeah, this is a great example. So what we're doing within our client portfolios is, we had last year, we were rolling 3-month Treasury bills. 6 months ago, we started rolling 9 and 12-month Treasury bills. And now bills that are coming due after 6-9 months, right, from this winter, we are rolling those 18 months, 2 years, 3 years, some 5 years at this point, because we can lock in these rates for longer. And it's not necessarily that we're going to hold it to maturity for 5 years, but if there's an opportunity that we see where the rates do drop and we're in a profitable position on the bond, that's additional excess return we've then generated for our clients, other than just simply being passive, buying a 10-year Treasury and forgetting about it.
Right. So when I think about cash investors today, or those those investors who have a long-term time horizon but are focusing more on the short-term bond, that 1-year US Treasury, locking in that 5.5%. I think of, have you ever seen that raccoon on the internet? He's playing with candy in a river, and he drops it, and it just evaporates in the water, and he looks so surprised, and he looks so sad, and then he grabs some more and he's playing with it, and he sets it down in the water and it disappears again. He looks surprised. We think that those investors who are pushing more towards short term, who have that 10-year horizon, that 10-year plus horizon, they're going to be that surprised raccoon where it's just going to go away and you're not going to get it back, right? If you could start locking in yields going farther out in the yield curve, well, guess what? When rates go down, your cash rate, well, if you were in cash, you would be getting less of a return. But as rates go down, if you lock in longer bonds, your return's actually going to go up. So you're going to be benefiting from that as opposed to staying in cash and letting it go down. So as soon as you miss that boat, you miss the boat, right? It's gone. You're not going to have that opportunity again. Sure, you can always, lock in the rates where they are, but that area for price appreciation when locking in that yield curve just goes away. So you're really taking a risk by focusing, short term, if again you have a longer term time horizon. If your time horizon is a year, you should be in cash anyway. And a U.S. Treasury, a short-term U.S. Treasury can be a great cash alternative instrument. We did have a question about preferred stocks. Someone asked if preferred stocks are a safe option in this environment. I would say, just to keep it high level here, it can be some good return potential from preferred stocks in this environment, given where rates are. You could think of a preferred stock as a long-term bond with credit risk. So when rates start to come down, that should help support the price of preferred stocks. Now, are they safe? I would say because of the credit risk associated with preferred stocks, you really should think of them as having stock market volatility. Okay. These aren't just, regular bonds, right? We have to look at the credit risk component of it. So I wouldn't necessarily call them safe. Could they be a good opportunity once rates start to come down? Yes, but I certainly wouldn't call them safe. So you want to jump to equity valuations?
Yeah, let's do it. We had a question come up, for someone with a 10-year time horizon, what's the ideal mix of stocks and bonds? Again, I feel like these questions are coming with just awesome segue points. We're going to get into specifically 10-year timeframes and what the returns of stocks and bonds are, because a big question we're going to dive into is, okay, what is, if I can get a 5% return in a 10-year treasury and just put all my money in that, what's the opportunity risk of not being in stocks, right? And so what we're going to talk about right now is how are equity valuations, right? How is the stock market priced currently relative to its history over the last, let's call it 20, 25 years, okay? And what we can see is stocks in 2020, 2021, they were on the higher end of historical valuations. You can see, Austin, if you want to circle 22 times earnings there at 2021-ish on the chart there. Right. This was over one standard deviation above the 25-year average, which is about 16.75 on a forward price to earnings ratio. Okay?
Let me just stop you real quick. So this line that we're looking at is the valuation line. So the higher it is, the more expensive. When it starts to drop, that means that the market is becoming less expensive per dollar of earnings, which you could see in 2008 when the market ran down. The stocks were trading at much more attractive pricing relative to their earnings. And that's what we're looking at now.
Yeah. And the big takeaway here is we can use the price to earnings ratio to actually flip that on its head, right? And look at where we are today, 17.83. It is higher than the 25-year average on a valuation perspective, but not egregious in any sense of the word. So we can flip this and actually get what's called an earnings yield. Do you want to walk through that calculation, Austin, quickly?
Sure. So what we're looking at here, when you look at a PE, 17.83 times. So the market in general is trading at 17.83 times the earnings of the U.S. stock market. If we flip it on its head, we get the ratio of how much the stock market is earning per dollar. And when we do flip it on its head, we get a percentage. So right now, if you do 1 over 17.83, you get 5.6%. That should theoretically be the earnings that you should see before inflation over the next 10 years from stocks. Okay. So with inflation around 3%, let's say it stays at 3%, that translates to an 8.6% expected return from stocks over the next decade. If the Fed gets rates down to 2%, inflation down to 2%, that translates to a 7.6% rate of return that could be expected from the market. Now, if we think about bonds, right now, why not lock in that 5.5%, 1-year U.S. Treasury, even the 5-year U.S. Treasury, that's a little bit lower. Well, when you think about it, the 5.5%, that is not adjusted for inflation. So actually, if we back out 3% inflation, which is roughly where we are right now, you get a 2.6% return after inflation. So what would you rather have, a 2.6% return after inflation or a 5.6, right? So that's the way you have to think, especially if you're a long-term investor.
Yeah, and now maybe we can flip Austin to the 10-year bond versus stock returns here. But it ultimately comes down to time horizon and your risk and how much volatility you can accept. Because while these return projections are just that, they're projections, what you need to understand is the volatility associated with different types of investments. So while stocks may offer greater longer term return potential, that comes with the risk of anything happening in the short run. So this chart here, we have on the left side of the chart, we have different returns, with 0 being the middle line. So the green here represents US stocks, the blue represents the aggregate bond market, and a 50-50 portfolio is the gray here. So what you can see is over a 1-year period, various 1-year periods in the stock market, the returns have been as good as 47%, as bad as down 39% in 2008. Massive swings, massive potential there for both high gains, high rewards, and high losses. Now, with a bond portfolio, you can see that the downside is much more limited, and you still possibly can have more upside in 1-year period. Okay. Now, as you start to expand out your time horizon, so 5-year rolling periods, 10-year rolling periods, 20-year rolling periods, what you can see is that the volatility, the difference in the highest and lowest returns, starts to shrink dramatically for all asset classes. Okay. So we're talking about the 10-year treasury at 5% today. Let's focus our attention there. You can see that the best 10-year rolling period was 19% annualized for the stock market. That was a phenomenal period, almost 20% year-over-year returns for 10 straight years. The worst, though, was actually -1%. So there was a 10-year period, I believe that was in the dot-com and then 2008 window there, the lost decade, if you will, where stocks annualized -1% on a total return basis. Okay, not very good. So there's still volatility there, but the return potential is great. In bonds, we have never seen a negative 10-year period in bonds, which is fantastic, but there's still some volatility there. The really interesting part is when your time horizon can go even longer, to 20 years out. When we look at 20-year periods, we can highlight the average there of 5.5% for bonds. I like to use that as an anchor. Over 20-year periods, the average return that bonds provide is 5.5%. Okay. So right now you can get almost that in a 20-year bond, 5.2%, I would say, is what the 20-year bond is trading at. Now, let's look at stocks for a minute. Over 20-year periods, you can see that the worst 20-year period for stocks was an annualized 6% return. Okay, so this is better than the average return in bonds, and that was the worst for stocks. So really, the longer time horizon someone has, the more comfortable they should feel, not day to day, not month to month, year to year, but over long periods of time, the more comfortable they should feel with having a large portion of their portfolio in stocks. So I believe the question was specifically around 10-year time horizon. Unless you're 85 years old, I would say your time horizon is longer than 10 years, okay? Because that's how long you need your money growing and working for you. So this is a great slide for you to consider and a great topic of conversation to have with your advisor.
Right. And one of the things that we do with clients is we do a wealth analysis where we actually project your money going forward under hundreds of different trials, looking at up years, down years, everything in between, to try to get as best of a realistic expectation as possible of where the markets can go from here. I would definitely suggest, if you haven't already, to do that with your advisor. Or if you're not working with a Withum Wealth advisor, to reach out to us, and if you'd like to work with us, we can help with that analysis. And that analysis actually will assign a probability of success for each type of allocation. So, for example, maybe if we look at 30% stocks, you may have a 70% probability of meeting all your goals and not running out of money. But if we go to 60% in stocks, maybe you have an 85%, or vice versa, probability of success. But those are things where we could look at the numbers. I just wanted to touch on one more slide. I know we're crunched on time here, but this slide I think is important based on some of the questions we got in about being worried about the market, right?
Yeah.
You have the Mideast. What's that?
1 second, Austin. We are coming up on time. We have about 5 minutes left. So we're going to try and cover this, just given everything that's going on, but did want to just make a plug before we run out of time. If people have to jump to 1 o'clock meetings, after the webinar, you will be getting a survey. Please fill that out. It should not take you any more time than a couple minutes. And it really does help us shape how we handle these webinars moving forward. And there will be a replay, recorded version of this posted to our YouTube channel, which you can check out. And we have also started a podcast called Amplified Wealth. You can search that in the Google machine or anywhere where you listen to your podcast. But we're going to be doing more conversational topics such as this on a monthly basis. We had one a month ago with a colleague of ours, Monica Halife. It was a great topic on everything from the Fed to interest rates and bond yield curves and the like.
Right.
So I'll make that plug, and let's dive into.
Please follow and like too. We got to fool the Google machine that everyone wants to listen to us so that they rank us higher when people search for us. But okay, so we've had a lot of questions come in about Mideast unrest, high rates, the election. Will all these factors derail the stock market and the economy? There are arguments I could have for each one of these topics that they could cause short-term volatility, but in the long run, where we are today may be a positive. So, for example, wars tend to be good for the markets because they just consume. Wars consume. Think of all of the materials and everything that goes into having a war, right? Everything from making the ammunition to the clothing being used, et cetera, and then the rebuilding period after. So wars actually tend to be very good long-term for the markets. High rates, we felt the pain of high rates already. I would expect that as rates come down, we should start seeing boosts in the market. But however, we don't know when that timing is. And right now, high rates should continue to cause volatility as the market tries to guess or understand when rates are going to come down. The election, markets don't like uncertainty. So as the uncertainty builds, as we get closer to the election, and the CFOs who are running these major companies don't know the best direction to move their companies, stock prices should start to be volatile around that. But once, whether it's a Democrat or Republican, whoever gets into office, and once those CFOs of those major companies understand what tax policies they have to work within, et cetera, then that certainty comes into play and the market tends to do better. Now, I bring up this slide because the lines in the slide right here are showing when investors are more optimistic about the next 12 months and when they're more negative about the next 12 months in the market. So as you get to a peak, investors are more optimistic about where the market's going to go over the next 12 months. When you get to a trough here, they're more negative. And what we did was we said, all right, well, when we do hit those troughs, what was the performance 12 months out? When we hit those peaks, what was the performance 12 months out? What we found was when investors are most bullish about the markets, the next 12-month returns are around 3.5% in the market.
That's about a third of the long-term average.
Right. When investors are the most negative about the markets, the average return is 24%. Okay. So what this tells me is, one, the market doesn't care what we feel, doesn't care about our emotions. Investing is very emotional. When we are negative about the markets, what about the economy, right, or where we are, we tend to want to pull back on our stock allocation. That traditionally is actually the best time to be adding to your stocks. Now, why is that? That's because as more people are fearful of the market, they're more likely to sell and care less about the earnings of the companies that they're actually holding. So they're creating discounts in the market. So that tends to be a good time to buy, right? If the mall was trading at a 30% discount, everyone would be running towards the mall to pick up as much as they could, right? When the stock market's trading at a 30% discount, people are saying, well, I don't feel good about where we are in the market, and they're running away. It's the opposite, and it shouldn't be. We should be running towards it. So where we are now isn't quite a low. However, it is around where we were during the 2008 financial crisis, right? We're still in that same range of consumer or investor pessimism about the market. So I would argue that from a investment perspective of, where should I start legging in? When you feel negative about the market, when you feel like pulling that money out, that tends to be the best opportunity to leave your money where it is or to add more to it.
Yep. Yeah, this is just a phenomenal behavioral mind trick that the market exemplifies. A prior guru and employer of mine used to say that the market is almost like the great humiliator. It does whatever everyone else least thinks it will do. So always keep that in the back of your mind the next time you're worried, or simply just reach out to us and give us a call. That's why we're here.
There you go. We'd love to talk to you. Thank you guys for attending this webinar. As Adam said, please look us up on YouTube under Withum Wealth, and then also on your podcast channels, whichever podcast app you use. You could find us under Amplified Wealth. Please like and follow. We would greatly appreciate it. Thank you.
Thank you, everyone.